Nothing more complicated than what percent of your earnings each month you're going to set aside. Thanks, Don.
Got it, Margot. I didn't realize you were a financial planner. I don't think you ever told me that before. So you learn something new every day.
I was a fee-based financial planner and a money manager.
And then you got into the good side of business, huh? Helping people with home inspections. So that's good. Good to hear that. Another quick shout out to a few of our other partners that make this series possible. Milestone Title, Lori LaCoppola, Tony Fowkes, Ryan Owens and the team. We thank you, of course, for your support and your sponsorship for this particular series. You guys do a lot of great things educationally to help the community. Also, Beta Bay Lending, DJ Rondo, I believe, is traveling right now, but DJ and Sam and the team over there, Gail, want to thank you guys publicly as well for your support and sponsorship of this series. If you are looking for any great lenders, Beta Bay definitely can help you guys out. We also partner with Jacob and John Sutton and Jacob Downs over with Kazan Construction Group. They are a great roofing partner. And as a top producer, you can never have enough good people on your list. So these are some of the people you can look at. And last but certainly not least, Celebration Title with Rob Medetsko, Amanda Douglas, the owner over there. Celebration works with us in multiple markets, and just a public thank you to you guys too for your support and the way that you help our platform. So once again, thanks to all of our partners, and those specific partners help sponsor this particular series and bring it to you guys on a regular basis. Okay. All right, guys, with that being said, let me just take a second and introduce to you our main panelist today, and that is none other than Lee Kearney. Lee, it's good to see you, man.
Thanks for having me.
Yeah, no doubt. It's my pleasure. Just a couple quick things, and then we'll dive into our questions today, Lee. So if you don't know Lee, I thought this was kind of interesting. Since 2004, Lee has bought and sold over 7,000 properties all over the country, but mostly focused here in the Tampa Bay market. Lee owns Spin. He's the CEO of Spin. Spin stands for Southeast Property Investments Network. They've built their business on fix and flip properties across the U.S. I thought this was impressive. The Spin flagship trading company had a sales volume of over $500 million to date. This year, Spin has had a lot of focus on commercial development, quick flips, and then raising capital for other real estate related funds. Lee has his hands in multiple real estate businesses. He's also started a Florida Advanced Supplement Technologies in 2013, which is a company that serves the medical cannabis market in Florida as well. He also has he's the co-founder of what's called Altitude Brands, which is an exclusive distributor for multiple different brands all throughout the country. Lee's a local guy, an MBA from the University of South Florida. And I also thought this was neat that Lee has been very involved with a local organization called Redefining Refuge, which is a local specialized nonprofit service provider that it's an agency that basically fights human trafficking to combat the sick challenges of the sexually exploited and trafficked youth that I know that all of us find as an issue that we would love to do something about. And so our company as a whole, N2 Publishing, the parent company of Real Producer Brands, actually also donates over $2 million annually to various causes to fight that particular issue. And I thought that was neat to see that there's a local organization that was aligned to that as well. So Lee, we're excited to have you here. I know that you have a lot of information and wisdom and knowledge in this particular topic. So I know I just gave kind of a rundown of your background, but I thought it might be helpful since people do learn a lot based on people's stories. If you wouldn't mind kind of giving us a brief rundown of your career, if you can just kind of tell us your story a little bit. I'm going to go ahead and mute everybody except for Lee. There's a little bit of background noise. Okay. All right, Lee, if you can unmute yourself now, that'd be great. Perfect. So Lee, why don't we start with there? Just a little bit about your background. If you want to give us an example of your career, what that path has looked like over the years, how you even got yourself interested in real estate investing, and how that's evolved a little bit. So we'll start there.
Sure. So I actually started in real estate in 2003 by accident. I bought a condo back in Ireland. I'd moved back there. That's where I'm originally from. So I moved to Florida in 1996. I got my degree, got my master's. Actually, I'd almost finished my master's, but decided I wanted to get into the workplace, did not want to finish it, wanted to start working. Went back home to Ireland, worked in my father's company, bought a condo, hated it, put it back on the market and sold it, made more money than my base salary. So I'd actually flipped the property by accident. And that's when for me, the light bulb went off. I said, wow, there's something to real estate. I knew I'd got a decent deal, but I didn't realize that you could transact and make tens of thousands of euro at the time by basically doing nothing. So I decided to move back to the States, finish off my master's. I moved to California, and actually a gentleman I went to church with was flipping houses. So one thing I'll say to everybody on this call, for me, there's no dumb question. I asked this guy a lot of questions, asked him how I could help him, started going to Home Depot, helping him fix up his homes, and figured out what his buy box was. So he gave me a buy box, gave me a price range. It took me about 4 months, bought my first intentional flip. Did everything he told me. I remember putting out all those signs that first day, come see my open house. And miraculously, a guy walked in. I'll still remember his name. My first buyer, his name was Jose Chalet. He said, I want this house, full price. We close in about 30 days. And actually that particular deal is posted in my main office, just because for me, it's a reminder of where I started. Did my second flip in California, moved back to Florida. At that point, finished off my MBA and started asking a bunch of questions. I said, where do I find, below market value properties? I didn't really understand the term distress. I didn't know foreclosures. I just knew that I needed to buy below market value in order to make money. So one of my good friends' fathers was buying at the courthouse steps. I said, what's the courthouse steps? What's a foreclosure? Started going down to the auction, realized that it was just a bunch of sharks in a room bidding on numbers. There weren't even addresses. It was just numbers being auctioned off. And so it took me a few weeks to really figure out what I was doing down there, found out that the numbers actually related to case numbers. The case numbers were published in a book by a lady named Tamara. And so once I kind of got in the flow there, I said, okay, I'll drive the properties in the morning. I'll go bid in the afternoon. Fast forward about 6 months later, I became one of the largest buyers at the foreclosure auction in Hillsborough. Then I said, okay, there's not enough houses in Hillsborough. How do I buy a 2 auction? So I had an earpiece in and I controlled 2 auctions. While being at the Hillsborough auction, I had a bidder down at the Pinellas County auctions. And so it just snowballed from there. By 2006, we started doing dozens of homes. 2007, our volume stepped up again, then everything crashed and burned. And so for me, when I look at people that are influential in my life, I like the rise and the fall, because I feel like it really rounds out someone's character. I can relate to that. I made and lost a couple $1 million within my first 2 years of real estate. So the good news is I was in my 20s. I could bounce back. It wasn't the end of the world, but I can tell you that it really humbled me. I realized that money doesn't make you happy. Making money is fun. Not having money sucks, but money by itself does not make you happy. And so I decided I'm back at ground zero. I'm going to start wholesaling. Why? I was rehabbing into a downward market. And that's when I realized an important lesson. There's always money in real estate, but you got to be on the right side of the trade. And that's something that I didn't have a coach. I didn't have a mentor. I thought I was invincible. And I was for 2 years because I was riding the wave. And I see a lot of that happening right now where operators that have gone in the last 5 years, they've just been riding an upward wave. Not only has it been an upward wave the last 2 years since COVID, almost 2 years at this point, at least 18 months, it's been an exponentially rising market. You look at Tampa Bay, 25% year over year growth. Agents are making money. People doing mortgages are making money. You've got flippers making money. You got landlords making money. Everybody's making money, high rent and appreciation. It's a win-win market. And so that kind of market is easy to win, but it also gives people a false sense of security. So going back to 2008, started wholesaling again, really put my head down. I said, I need money to come into my bank account because I just had a whole bunch of money leave. And within my first year of wholesaling, was able to do about $1 million in wholesale fees and really snowball from there. I realized, okay, wow, the same houses that I sold in 2007 for 150 and 200,000, I can now buy in foreclosure for 30. And so we started buying a lot of rentals. In fact, we built up a rental portfolio, about 350 doors at that really low pricing. And now as we look back, that trough was about 4 years, 2008 to about 2012. Some could even argue 13, stuff was really, really cheap. And so again, you don't know this, hindsight's a wonderful thing, but we bought during that curve and then held on to properties. And my only regret is that I sold them too early. We sold a lot of properties in that 100 to 150 range that are now could be sold in that 180 to 220, maybe even 250 for stuff that we literally bought for $30,000. So as the market evolved, 2009, 2010, our volume really started stepping up. We started doing hundreds of properties a year. In 2013, I partnered up with a hedge fund, became an operator, and also was doing a lot of their acquisitions. We did about 2,500 transactions in 2013. At that point, it put me into bad health. We were processing about 200 assets a month. I mean, just absolutely insane. You think about a busy month with 20 closings, that was us a day. So I would come in and there'll be a stack this high, just documents. And so we had to really systematize our business. We had to institutionalize our business, really figure out, okay, how do I make real estate a production line? And that's when I developed with my IT director at the time, who's now my CTO. We turned real estate into production line. Okay, what's pre-acquisition? What's acquisition? What happens after we buy it? It either goes to the construction department, it goes straight to marketing. Okay, it goes into a title mitigation department. So we really institutionalized that process, and we're able to basically process as many assets as we could get. There's another lesson I learned back then too. Having deal flow and having processes is great, but you got to have a lot of capital. So we really focused on raising tens of millions of dollars in lines of credit from both private and institutional capital. And that really, what I would say to everybody, there's two things that drive this business. It's deals and money. If you don't have both, it's very hard to be an operator. You can be an agent and you can transact without having both. You just need deals, right? Because you're just brokering those deals. But if you want to be an operator, you have to have deals and you have to have money. And even today, as I look at this crazy competitive market, what I see is deals and money. And the biggest thing that you have to have right now is you got to understand, if you want to be an operator that survives, how do you consistently buy properties below wholesale? So 90% of our focus is, as a company, is buying properties that our competition can't buy, buying them at prices cheaper so we can compete in a highly competitive market. And as you'd mentioned, we entered the cannabis space back in 2013. We were ready to apply under the Charlotte's Web ruling here in Florida, missed the boat because that didn't make business sense, and did not realize until later on that that was actually going to be the stepping stone for those operators to then receive a full THC license. So we started in Oklahoma. We're now operational. We're an MSO. We're in Oklahoma. We just commenced in Missouri. We will be commencing in Mississippi as soon as that bill is passed, which we believe will be imminent. And our goal is to apply for a Florida license now officially. There's the next round of licenses opening up in that space. So that's really an overall picture of me, my background, where I'm at today.
A lot there, Lee. Appreciate you. You did touch on a lot. It's one of the questions we're going to get to are some of your favorite strategies for
Sure.
building wealth through real estate investing. And in your story, you touched on a couple of the different things that you've done, strategy related, to be able to build the business that you've had. Obviously, with real producers, a lot of our audience are real estate agents.
Yep.
And so when you think about how you've worked with real estate agents over the years, and some agents I've interviewed do what you do on maybe usually a little bit of a smaller scale at the level that you're doing it, but they have their residential retail agent business, and then they have kind of another investment side of their portfolio that they work with other investors on, or that they themselves are an investor on. Can you talk a little bit about your experience of like working with agents and how you have seen that type of dynamic be the most profitable, the most fruitful,
Yep.
what you look for when you're partnering with a great agent, what agents can do to, whether maybe they're used to just being, well, I don't want to throw too many questions at you. Let's just start there.
Sure. Well, I think first of all, I'd like to say I'm a licensed broker here in the state of Florida. And I think where a lot of the battles come in is that investors don't want to work with agents and vice versa. So I try to enter the market when I first got into real estate, trying to work with agents and figure out how we could work together. And I believe if you're bringing value, whether you're an agent or an investor, there's ways that you can work together. And so I became licensed very quickly after becoming an investor. For me, it was access to data, lowering my friction costs and buying and selling properties. And as far as working with agents, I mean, there's agents that understand the business they're in, and there's agents that don't. And again, this is my opinion for what it's worth. I think I've got a good amount of experience to justify this position. But again, I want to be really clear. This is my opinion. Agents that get it realize they're there to facilitate transactions. Agents that don't get it try to stand in the way of deals. They'll talk their buyer out of doing something. I mean, we see this all the time. Well, they'll place an offer on a property, then they'll say, and we're demanding all these repairs. And I said, okay, is that you saying that? Or is that your buyer saying that? And so we try to qualify those questions because we want to know, are you representing your buyer to facilitate a transaction, or are you standing in the way of a deal? And I think the agents that really I've seen excel over the years, process a lot of assets, really excel in their field, are agents that understand the business they're in. They facilitate transactions. So that would be my first comment. The second thing I've noticed regarding agents that get it and agents that don't get it are agents that understand that the market moves and the opportunity moves. So they're not stuck in a strategy. They realize that, okay, if hedge funds are buying everything in town, how do I sell to hedge funds? If we're at the bottom of the market and it's going to be, people that buy at the bottom of the market, there's going to be private capital. There is no retail buyers. I got to move and get into the REO space, right? I've got to work with institutions. I've got to work with buyers that want to buy at the bottom of the market or buy and hold buyers, and they move. Right now, we've got a great luxury market because, you've got land trading for top dollar. There's a lot of agents that said, okay, this is where the opportunity is. I'm going to specialize in waterfront luxury teardowns, for instance, or I'm going to specialize in selling luxury new construction. And the agents that really excel are willing to move with the market instead of being stuck in a strategy. And it's also the same for investors. Investors that don't move with the opportunity get left behind. Right now, we've got Zillow, for instance. Zillow, big elephant in the room here. You go onto Zillow and type in an address in a primary market. We'll call it a cookie cutter home in, say, Riverview or Wesley Chapel. 99% of those Zillow listings have a new feature, and it's Zillow's offer. Zillow's offer is literally the Zillow value. And so we as investors and agents and brokers have to say, am I just going to sit here and let Zillow cut me out, or am I going to figure out a way to bring value? And that would be my third comment. Agents, they're there to facilitate transactions. They're the ones that win. Agents that move with the market, they win. And thirdly, agents that focus on bringing value versus just trying to sit in the middle of a deal and collect fees, they're the ones that excel. Agents that want to essentially not bring value and still collect 3%, 2%, 6%, whatever that looks like, depending on whether you're representing one side or both, they're going to get left behind. But agents that really say, okay, how can I do something different than Zillow? How can I do something different than OfferPad and bring value to both the seller and the buyer? They're the ones that make money. And that would be, again, at a high level, what I've seen in the marketplace. Things are rapidly changing. A traditional agent that wants to do things traditionally is going to get cut out because Zillow's gunning for you. OfferPad's gunning for you. Open Doors gunning for you. They're intentionally, with their business model, trying to cut you out. And I saw this 5 years ago, Don. 5 years ago, I could see that Zillow was trying to create a marketplace that was sticky so they could control information on real estate. They knew by creating a marketplace that everybody went to as their go-to reference point, they could then start charging agent for leads and then miraculously start really charging agent for leads. So now you get a whole lot less leads for a whole bunch more money. And now they're saying, okay, now that we control the marketplace, how do we cut the agent out? How do we collect those fees? It's not a surprise to me. And if it's a surprise to anybody watching this, I would just say, keep your eyes open, see what's happening. The market's moving and you have to figure out how to move with it and how to provide value. And there is a place. There's always going to be a place for an agent, but it's got to be an agent that provides value and does something different.
Love that. And I know that there are many agents, not only on this call, but also through our Facebook stream. And if you are an agent who has a lot of experience in working with investors and wants to chime in at any point during this conversation, feel free to use the reactions button there at the bottom of Zoom. You can simply raise your hand if you have a comment or something that you want to throw in. We'll make sure that we get you, incorporated in the conversation. So you can use that option on Zoom. You can obviously also use the chat box if you want to throw any questions in the chat box, or just throw a comment in there that you'd like to speak up on a few topics. So I know some of you guys have done a lot before in working with investors like Lee, and probably can add some perspective to what you've experienced as well. Lee, I wanted to also ask you to elaborate a little bit more on, so earlier you were talking about how you had a strategy of fix and flips for a while. You've had a strategy of wholesaling deals for a while. For some people who might not be as familiar with like even some of those terms, can you elaborate a little bit on just like what that wholesaling strategy really is? And, I've even talked to some agents, not necessarily a lot of the top producers, thankfully, but I've talked to some agents who think that like wholesaling is illegal, right? That's still, that belief is still out there, right? And so can you elaborate a little bit on just, what wholesaling is, how that's worked in your business, and how these different strategies have all integrated together?
Absolutely. Well, so back again, when the market was in disarray in 2008, my financial situation was in disarray. I had to figure out how to get money to come into my bank account. So when I referred to wholesaling back then, I was talking about just assigning contracts. And so we were either A, assigning a contract, which is the traditional form of wholesaling, or B, we were doing a double close. Now in Florida, that's not illegal. In certain states, it is. The big area where people get completely off base on this topic, it's down to disclosure. Wholesalers that don't disclose that they have a contract and pretend to be an owner, they give other wholesalers a bad name. Wholesalers that are unwilling to work with agents end up pitting investors against agents. And so for me, again, I had no problem. I'm going to double close a deal. An agent brings me a buyer, the agent gets paid, no problem. Now, where again, I would say this to you, if I say, again, put myself back in 2008, I've owned this home for 2 years, love to sell it to you. And then we get to the closing table and they're like, well, actually, you don't own it. In fact, you're doing a simultaneous close. So we really perfected our paperwork back then. It was all about full disclosure. Our contract with our buyer would say our contract is contingent upon us closing with our seller. And even at the closing table, our title company would say part of your funds are going to be used to fund your seller's transaction with their on their buy side with their seller. And so what I'd say to everybody out there, try not to make those blanket statements that something's right or something's wrong or something's illegal. Because again, I don't believe there's any attorneys on this. I'm not a licensed attorney in the state of Florida. I'm a licensed broker. But I've seen that a lot of people, again, they step in and overstep the mark in making legal judgments when they're unqualified to do so. And I'm also unqualified. Again, I'm not a licensed attorney here in the state of Florida. But I have seen that there's ways to accomplish. If you've got a buyer, you got a seller, you've got a price differential, there's legal ways to do everything. And you just have to work with good attorneys, work with title companies that know what they're doing. And there's ways to structure deals that are legal and give full transparency. I would say that that's really the missing word, Don. People that are not transparent about what they're doing end up getting themselves into trouble. And that's why we haven't had any issues. There's been allegations over the years. There's been news articles written, but nothing that actually had any substance to it, because we've always played by the rules and make sure that we're doing stuff honestly, ethically, and transparently.
Great stuff. And in your experience, Lee, I'm assuming that the majority of the deals that you guys are flowing through your systems right now are off-market deals. Is that a fair assumption?
Yeah, well, that goes back to shifting with the market. So we were an auction buyer for many years. I would say for the last, we'll call it since 2012, 2013, where a lot of the distressed inventory shifted from the MLS to platforms like auction.com, Zone, Hudson and Marshall, places like that. So we became a huge buyer. I mean, at certain points back then, we'll call it 8 years ago, we were buying 20, 30 assets a week off those platforms. But then as the prices rose and people started gaining equity again and we're not underwater, And so the foreclosures started dialing down. We noticed that the REO inventory really dried up too. And then it came to a screeching halt when COVID hit. So we shifted our entire business model away from being an auction platform bidder, which is really an underwriting skill set versus a sales process, to a completely sales driven process. So for us, the business we're in today is a data and sales business, which means we scrape a lot of data, and I've got a team in India that does that. It then goes over to a call center in the Philippines to make sure that we can create rapport with those sellers. And then it comes back domestically to our closers here in the US, and we actually close those deals. But what that business is today, it's a sales business. So we're not chasing assets anymore, we're chasing sellers. And so we focus exclusively in the entire state of Florida. We look at distressed sellers with equity. And so anyone who's not distressed is not our seller. Anyone who does not have equity, not our seller. And I say that to you because the opportunity is about to shift. Once they start ramping up foreclosures again, which is expected to be after the CFPB moratorium ends in January, we're going to see that the opportunity for agents and investors is going to shift to a short sale market. Because what's going to happen is lenders do not want to see a flood of foreclosures. So they're going to want, different buckets. They're going to want to silo a certain percentage of their bad loans and get them off the books with short sales. Depending on the mortgage insurance, they're going to want to run certain loans through a foreclosure auction, or depending on the amount of equity. So the opportunity is definitely going to shift in 2022, and it's going to be primarily driven by the banks actually starting to move on foreclosures. But right now, the foreclosure market's dead. So we had to look at, okay, where's the opportunity? You got a lot of distressed sellers. They're not in foreclosure, but they've got a ton of equity. And so that's exactly what we go after. But I also, again, like I just said, that opportunity is definitely going to shift in 2022.
You touched on a lot of some of the points that I was going to ask about as well, as far as your current thoughts on the market and where you see things going.
Sure.
In the future. I appreciate that. What
I can expand on that if you'd like.
Absolutely. I think it's always a question that we hear all the time is just, what's happening with the market? Where do we think it's going? And someone that has your level of experience, I think it's always good to hear your opinions on the different market trends and thoughts. So if you want to elaborate on it, go ahead.
Sure. Well, I mean, you've got a lot of competing interests right now. You've got a lot of people coming to Florida, which again is used to basically say that the Tampa Bay market, for instance, is going to go up forever. But then you've got other statistics that show that we've hit that affordability limit. You've got a median price in the Tampa Bay area of about $350,000, which far exceeds the previous market cycle. You don't have wage growth anywhere in line with that. So from a basic standpoint, we're hitting that affordability ceiling here in the Tampa Bay area, which is concerning. If you look at the moving average over the last 5 years, we've gone way above that the last 2 years. 25% growth in 1 year is insane. And so same thing with rent prices. You look at rent prices over the last 3 years, gosh, I don't have the exact statistic, but just looking at it anecdotally, it's probably about 50%. I mean, rent is just insane right in Tampa, and same thing in St. Pete. So you've also got this halt in foreclosures. So depending on who you ask, there's at least 1.5 million loans that are seriously delinquent on single family assets. And the average time is well over a year. I think it's about 380 days in the last statistics I saw. And so then you've got this weird job market where you've got more job openings than you've got applicants. And so the economy is definitely in a very, very strange state. We've borrowed trillions of dollars to prop up our economy. Now, the statistics are showing that US household savings are dwindling. And so now you've got foreclosure starting to ramp up. You've got savings coming down. And so this is where I see an interesting intersection in 2022. If people no longer have extra money because they've blown through their stimulus money and they're not working because a lot of people have left the job marketplace. And now you've got a situation where the bank's saying, okay, well, the chickens have flown to roost. You got to start paying something on your mortgage. What I found from last cycle is it doesn't matter if they lower your payment to 25% or 50%. People that are either going to pay, people that don't pay, just stop paying. And the big situation we've got today is that people haven't paid in over 18 months on average. And in fact, that's what the statistics show. That's at SDQ list, which is typically 90 days or more, is now well over a year. So I posed the question to the group, how many of those people do you think are actually going to pay? And the reality is not a lot. That doesn't even account for the people that have paid and are going to stop paying once their equity dwindles, which is what happens when you've got an excess supply and decreased demand. That causes price to compress. So I think just based off the moving average, the market has to have some kind of a reset to come back to normality, which is probably going to be in that 15 to 20% range. Now, the crystal ball question is, okay, is the market going to crash? The big difference this cycle versus last cycle is you've got an institutional backstop on typically B grade assets. They don't want to buy in lower grade neighborhoods. They also don't buy luxury. But in that sub-median price neighborhood, you've got a lot of institutional buyers. They've securitized those assets. They're very happy to buy at a 4 cap. And so that's a big difference from this cycle versus last cycle. But the reality is there is a huge backup of distressed inventory that's going to hit the market over the next 3 years. And the statistics show really that, again, the forecast that I'm looking at, 22, 23, 24, and even through 25 is when that inventory is going to hit the market. So I think what we're going to see is a degradation in the market next year in 2022. It's interesting to know we've got a lot of live data. Before COVID hit, we already saw a slowdown in the market at the beginning of 2020. We saw the market come to a screeching halt in March 2020, all the way through June 2020, and things didn't start to take off until July 2020. So a lot of people talk about the COVID effect and how good the market is. Sitting in the seat I'm sitting in, we saw a slowdown happening at the end of 19 and through the beginning of 2020, right before COVID hit. I suspect that we're starting to hit that point where in certain areas of the market, we're going to see that there's a slowdown. Also, our internal data, for what it's worth, we've actually seen a slight price decrease in assets that we've purchased in Florida. We're talking like 1.3%, so don't freak out about that, since June 2021. So what we're seeing in our internal data is that the market peaked this summer. But again, the regular market won't see that for about 6 months from now. I'm just pointing to what our data shows in our database.
Wow, a lot there. So if I'm a real estate agent who's interested in wanting to, the topic here today is building wealth through real estate investing, right?
Yep.
So if I buy into a lot of what you just said, and I think a lot of people do, what's some of your advice as to how I would want to position myself as a real estate agent to take advantage of this, whether that would be partnering with investors such as yourself or just building my own portfolio as an agent? What would be your advice on how to try to position myself properly to take advantage of the opportunity?
Sure. I try to listen to people that are worth $100 million or more in my network. And what they've told me since day one is you buy at the bottom, you control at the top. And so I look at a lot of investors that have been in the market the last 5 years and are building a rental portfolio. And for me, I can't comprehend that. They're saying, no, I don't want to buy at the bottom of the market. I want to buy at the top. And people will use low interest rates to justify that. But wealth is not built at the top of the market. You can get rich at the top of the market by trading assets and taking advantage of the hype in the market. But wealth is built at the bottom of the market. That's when you buy by acquiring assets that other people don't want to buy, buying at prices that are far below market value. And so just like the stock market, the real estate market overreacts. In general, markets overreact in a negative situation, which is why you get those extreme bargains in a bad market. Does that mean everything's going to crash? No, it doesn't. Because again, you've got Wall Street now that come in, instead of owning the paper, the asset-backed securities, they actually own the assets and they own the paper. And so you've got a completely different dynamic. And so for me, the opportunity as an investor is going to be buying what they're not buying. The issue I have with the luxury market is that when the market's in disarray, that's a tough market to make money on because it's heavily dependent upon financing. And so, yeah, you can buy a $3 million house for $1 million, but who's your buyer? If you can't get financing, who are you going to sell it to? The issue I have with competing with Wall Street is I can't compete with someone who's buying at a 4 cap. I can sell to them, and that's a good place in the marketplace to be, to sit in the middle of deals and selling to them. So being a seller to Wall Street makes a ton of sense. Being a competitor makes no sense. So I see a lot of opportunity in working class neighborhoods and below, buying at the peak of the market. Also, the statistics show that FHA loans are 4x in default compared to conventional and VA. Now, the big difference between this cycle and last cycle, all loan types were approximately the same. as far as the default rates go. Now what we're seeing is that there's a huge disparity between FHA because of the strict underwriting on conventional and VA. We're seeing a big difference. Every loan type last cycle, they were just handing out loans across the board, but there's a big difference. So if we can see the distress in the FHA loan types, we got to be looking at FHA concentrated neighborhoods. And so that's a big part of our strategy. We can see the data is clearly showing where the foreclosures are going to be coming, and it's going to be in areas that are heavily FHA loan concentrated. So that's what we'll be targeting here in Florida, primary markets, and waiting for those prices to come to a point where the multiples make sense, the cap rates make sense, and that's what we're gearing up for. But I would, again, a lot of people forget these basic concepts. You know, you buy low and sell high. Farmers realize this for hundreds of years, right? This is what they do. I watch my dad at the auctions. We buy cattle. He'd wait till the end of the auction. There's the last few cattle coming through. There's no competition. Everyone else has spent their money, and he'd be buying the last few cows for like $20. I mean, literally $20. And he would sell these things for 10x that. And so I say that to you because a lot of people just forget that basic concept. They forget that the market moves in cycles, and they're caught up in the hype. And the right side of the trade right now is to control assets. It's to flip. I mean, even something simple like our fix and flip business, we had to add a lot of value several years ago. Now, how do we pass a 4-point inspection? How do we make it clean and functional? We're not ripping out cabinets. We're not remodeling houses. We're just getting them to a point that they can get financing. Why? Because that's what the market dictates right now. So moving with those opportunities, controlling versus owning. There's several ways to control. You've got option contracts. So that way you can hedge your bets. You can just short-term flip assets. You can assign contracts. You can broker deals. There's lots of ways to control assets without actually owning. But buying en masse at the top of the market is counterintuitive. If you look at the market like an ocean, imagine standing up if you had a surfboard and facing off with a wave. What's going to happen? It's going to knock you over. That's exactly what the real estate market's going to do. Anyone that thinks they're going to beat the market will find out very quickly over the next couple of years that a strategy at the top of the market of owning only works in an upward market where you got strong rent prices, you got people paying rent, and you got financing flowing, and you've got appreciation in the market, because appreciation will make up for a lot of mistakes. You can buy wrong, but if the market goes up 25%, how do you go wrong? Everybody's making money. You could buy a property a year ago at market price in Tampa Bay, do nothing with it, and sell it today for 25% more. So anybody can win in that market, but that's not going to be the case, and it's not sustainable over the next 2 to 3 years.
It is just such basic, investment logic to buy low and sell high, right? I mean, we've all heard it before. I have a lot of buddies of mine who are really in that whole cryptocurrency craze right now, and it's an interesting, feeder frenzy type mentality when they see Bitcoin go up past 50,000, and how many people are now like trying to get all in on something like Bitcoin when they could have gotten it years ago, and realizing where that cycle is right now is same truth when it comes to real estate. I appreciate you sharing some specific examples of what it means to control. But I think the truth of buying at the bottom, controlling at the top is a really, really important point for anybody to walk away from. There's a couple of questions that are in the chat line here that we can address.
Absolutely.
Mike asks, when you're speaking of distressed sellers, are you referring specifically to the forbearance lists, or what are some examples that you look at with distressed sellers? Sure.
I think we're talking about several lists here. You're talking about pre-foreclosure and SDQ, just to answer that question really quick. That's an industry term for seriously delinquent. That's defined as 90 days or more delinquent on your loan. So that's not a foreclosure list. That's seriously delinquent. So SDQ is considered seriously delinquent. So when I refer to a distressed seller, I'm looking for someone who's having problems, right? And so a lot of people mistake that a probate is not necessarily a distressed seller. It just means someone died. Now, someone that's in foreclosure or someone who hasn't paid, that's seriously delinquent. So you've got that pre-foreclosure list. Then you've got someone where the lis pendens been filed, which means a foreclosure has actually started. So then you've got that is the progression of, okay, you haven't paid in a while, you're delinquent. Now you're officially in foreclosure. And as you move through that process, you become more distressed. Hey, by the way, your property is going to sale next week. So that's one area of distress. People haven't paid their taxes. That's distress. Typically, a divorce situation in most cases forces a partition sale or some kind of a liquidation of assets. That would be another form of distress. Code enforcement, you don't maintain your house, that's another form of distress, because at some point in this country, between property taxes, mortgage, or a municipality, if you do nothing with your property, someone's going to take that property. If you don't believe me, just walk away from your property, wait about 3 to 6 months, and you'll figure out who's knocking at your door. It's either going to be the bank, code enforcement, or the tax collector, or all three of them. And so, we're looking for people that have something that's forcing them to do something with the asset. And that's really what we look at. There's questions coming in, where do you have access to those lists? We pull those lists. So for me, I mine those lists. I have a data team that scrapes public records day and night, 24/7. That's what I do. You can go to places like ListSource and you can buy the lists. But if you want to have a competitive advantage, really pulling your own lists, and not only just pulling the lists, but actually really identifying what you're actually going after. My personal opinion is you're going to have more success instead of that spray and pray model where you just go after everybody and see if something hits, for having a very targeted strategy. And a lot of people in this business, whether you're an agent or an investor, they forget to define their strategy. They just make statements like, I'm going to buy rentals. That's not a strategy. That's just a dream. Or I'm going to flip some houses. That's not a strategy. Yeah, I'm going to sell homes. I'm going to be an agent. Okay, what's your strategy? What kind of seller are you going? Are you going to be a listing agent or a buyer's agent? If you look at that right now, buyer's agents are in a tough place because you're competing against 50 other offers on a home in a lot of cases. A listing agent, meanwhile, has a listing, is sitting high in the perch, just waiting and looking at the 50 offers from the beach or from their condo or their home or from another country even, because they're the one controlling the asset. So when you really even look at a basic, am I a listing agent or a buyer's agent, it's much easier to be a listing agent right now. So let's just suppose you are going to be a listing agent. What kind of sellers are you going after? You can't go after everybody, right? Because then you can't get good at it. The people that make money in our industry, whether they're investors or they're agents or brokers, they specialize in something. They become really good at a niche. And so that's part of your strategy going, you want to go a layer deeper. So before you do anything, have an actual strategy. And again, it's got to be number specific and time specific. I'll give you an example. I'm going to buy rentals. Okay, well, I'm going to buy 2 rentals per month over the next 12 months at this price range. And this is my strategy for doing so. Now you put time and you put numbers on it. Or if you're going to be a broker, I'm going to do X amount of GCI per month, and I'm going to check that per quarter. And then you create mini goals, and then you have an end goal. That's actually creating a strategy. But just going out into the marketplace and saying you're going to just sell houses, or you're going to just find buyers, or you're going to just flip houses, you're going to just buy rentals. I'm actually amazed even when it comes to flippers. They put all this time and effort into their spreadsheets for flipping one house, and then their rental strategy makes no sense because they're just buying rentals, because the thought process is, well, if I buy enough rentals, I'm going to become wealthy. But they, again, like we talked about, Don, they're ignoring market cycles. They don't have an actual strategy of where to buy, what point in the market to buy, what kind of tenants they're placing in the properties. And there's a lot of things that are just not thought about.
One of my mentors told me a long time ago that the riches are in the niches. And it's a specific theme, motto from an investing standpoint that I've always tried to keep in mind. And you touched on that, the power of specialization and knowing exactly what your strategy is going to be. And it really boils down to knowing those goals and breaking it down, as you said. And then what it sounds like, at least one of the things I've taken away from you so far, is that you have really educated yourself on understanding your market cycles, so that way you can create a strategy that's going to be most profitable and conducive to what the market is telling you.
Case in point, Don, I just sold my office in Seminole Heights. I paid $250 for it and I sold it for $1 million. Am I in the right side of the trade being a buyer at $1 million or being a seller at $1 million? And I would argue that taking $750,000 in profit off the table at the peak of the market is the right side of the trade. And I say that to really make a point. I mean, I could give you example after example, and I will tell you, everybody on this call, candidly, we're selling everything we own right now. Every single asset that I own, I'm selling. Everything. Everything's for sale. I don't even have a primary residence. I'm renting right now downtown because I believe what I'm telling you guys on this call is that I believe in what I'm telling you, and I'm putting my money where my mouth is. I believe I'll be able to buy a custom home that someone else spent several $1 million on for a lot cheaper than that when the market flips the other way. And I'd much rather do that than buy at the peak of the market and watch my equity disintegrate right in front of my eyes, which is what happened last cycle. I mean, my worst nightmare, I bought a condo in South Tampa for $100,000. It appraised at $140,000. I got a loan for Bank of America for $70,000, and I short sold it 2 years later for $20,000. Now that's a very extreme example, and I understand the marketplace was different back then, but these memories haunt me and really etched in my mind that the market can shift. And the big thing that people forget, when the money stops, that's when everything flips the other way. Everything will flip the other way once the money stops. And typically that's a lot of that's driven by the stock market. You'll see that when the stock market starts flipping the other way, that's going to dry up the capital markets, which is going to dry up financing, which again trickles down to buyers leaving the market, not only retail buyers, but leveraged investors. Institutional capital leaves, they raise their cap rates. Even something simple, a big buyer like Amherst, if they raise their buy box from a 4 cap to a 6 cap, that completely flips the market, because what happens is that's going to drop what they buy, where they're essentially running that area of the market 20-30%. When you got a cap rate driven market, it's just numbers at that point. And Wall Street is very unemotional when they change their buy box. And I was an operator, I saw this. In fact, I could see my capital change on a weekly basis. I'd be given direction to buy every house in sight at the auction. Then the following week, we'd have a dip in the stock market to say, hold off buying for 2 weeks. I mean, I literally saw that in real time. And again, I deployed tens and tens of millions of dollars for different hedge funds over the years. And I watched that very numbers driven buying of houses. So when the music stops, it's all going to be driven around money. The first stage of this was cutting off stimulus, which has already happened. In most cases, that's why household savings is dipping, and that's publicly available data. The next step of this is going to be when financing starts to tighten up. That's going to curb pricing too. And then ultimately, if there's a big run in the stock market and the capital markets dry up, which is where institutional capital depends on their money, that's when you see institutional buyers either raise their cap rates or leave the market. And that's going to, again, put another hole in the market. So things are going to shift. I'm very confident in that statement. And you just got to figure out, do you want to try to get wealthy at the top of the market? Or do you want to take advantage of the hype in the market, sit in between deals as an agent, as an investor, and flip homes, stack cash, and get ready for what's coming? And I would rather be prepared for the next market cycle, because I just don't believe that wealth is built at the top of the market.
Out of curiosity, Lee, do you have money in the market itself, or are you pulling your money out of the market to be able to have it in a liquid account that's ready for when that cycle comes?
I have very little money in the stock market.
Got it.
Maybe 1% of my money.
There's a couple more questions here in the list, in the chat, I should say. Mary's wondering, the cycle you're describing, do you believe that that'll be, and within 2 years? What is your thoughts on, is it too early to make that type of an assumption? What type of a timeline are you thinking it would be?
So a good friend of mine, a mentor, actually manages billions of dollars of distressed assets and notes, paper for a publicly traded fund. They believe that their opportunity is going to hit Q4 2022. And the reason being is the major foreclosure boom is not going to even start until Q1 2022. And it's going to take several months for that to start to move through the system. Now, obviously, you've got the first wave, which is happening right now, which is pre-COVID loans. So pre-COVID loans, the banks are already starting to move on those. Then you've got most loans, which are restricted due to the CFPB moratorium. They won't be able to start to move on those until January, assuming they don't extend that again. So assuming that the party starts in 2022, keep in mind, Florida is a judicial state. So you've got trustee states versus judicial. A trustee state, basically what a lot of people don't realize, again, I'm going to dumb this down to third grade language, not meaning to insult anybody, but in a trustee state, you're essentially renting your home because
I'm going to need second grade language, Lee. That would be more like my steez.
So trustee states like Georgia, for instance, you're basically renting your home. If you stop paying, you're going to have your home taken away in about 90 days. Literally. Like you stop paying today, you no longer will be in your home 90 days from now. In Florida, you stop paying, they've got to ultimately default you and file a lis pendens and go through a court process. So when I say judicial, there's a court process, there's a judge involved. And because of that, a lot of people can manipulate that process and be in foreclosure for years. In fact, we purchased an asset from a major bank that they could not get this lady out. She was in foreclosure for 17 years. We took over that asset and it took us about 6 months. It was actually a pastor. Her name was Cookie. And she was probably the most difficult borrower I'd ever dealt with. And it took us 6 months to get her out. She represented herself pro se for 17 years versus a major bank, major institution. And they could not get this lady out. Now, on top of that, they didn't want the headline risk. And I can tell you that the process of foreclosure, there's lots of people that manipulated this last cycle, were able to hang on to their homes for 5-10 years and in foreclosure. And that's because of the fact you could file motions, you could compel discovery from the bank. Oh, your note's not correct. A lot of buying and selling of these asset-backed securities actually created a lot of opportunity because you've got banks that went out of business and a lot of borrowers took advantage of that. So the bank's paperwork is a lot tighter this time around. But my point being, Don, just because the foreclosures start early next year, it's going to take several months for them to actually get processed. Then you got the next problem. There's not enough judges. So now they got to bring in judges out of retirement to actually come in and process this. The clerk doesn't have enough staff, so they've got to ramp up. And the same thing happened last cycle. So yeah, it's going to be a ramp up period, but we're probably going to see the ripple effect of this, I would say, later next year. So that will be my personal opinion. But also, if the stock market dives before then, that's going to cause a degradation in the real estate market a lot quicker. And I would argue, for me, I don't care what your political view is. I think that what we've done, though, as an economy is we've over leveraged the economy. So something at some point's got to break with that, which is outside of just the real estate market. And if that happens, that's going to cause a run on the real estate market that's not caused by foreclosures. If we're depending just on foreclosures, it's going to take 2 or 3 years because there's such pent up demand and the supply even has to catch up with the demand, which is starting to happen now. And then again, you got buyers leaving the market because of the affordability index. But all that, if we just depend on the real estate market to start to slip the other way based on what's happening in real estate, that's going to take a while. But I think that this cycle is going to be driven by other factors other than real estate. And I suspect that we'll start to see that happen next year.
There's a question in here that we might have overlooked earlier. Mo was asking, where can you get the data of the FHA loans that you were mentioning earlier, concentrated properties?
Sure. If you go to the HUD's website, HUD has information. You've got big data providers. Again, you got to pay for some of this data, but just to give you kind of rundown of some big data providers. So the HUD government website would be a good place to go. CoreLogic has a lot of good data. Atom Data has a lot of good data. On their main web pages, they got a lot of good presentations and articles and things like that you can scrape for free. Black Knight would be another data provider. But again, you're talking about institutional level data. That would be probably the top 4 places where you could scrape that information for free without having to spend. I mean, just to give you an example, we spend thousands of dollars per month on data. So when I tell you guys this stuff, it's based on actually having purchased and being purchased for several years, institutional level data from major data providers. And that's what we do. On top of scraping our own data, we also purchase a lot of data too.
They don't say knowledge is power, but really applied knowledge is real power, right?
The entire economy now is driven by data. You look at, like I said, Zillow is moving to taking over this marketplace because they controlled the data. That's what they did. They spent several years building the database, and now they're reaping the rewards of that. I mean, it's no secret. Everyone thought, why would Zillow get on and just give everyone information for free? Because they were building their database. That's all Zillow's been doing for several years. Now they're cashing in on that.
I have a quick question that I'm going to have Mike jump into with a question. Earlier, Lee, you mentioned about everything boils down to deals and money, right?
Yep.
In this business, and
for an operator,
right? So as
Yes.
we discuss these different market cycles that you bring up, when the market gets into that zone where your alerts are triggered and it's buy time for you guys, at that point, if the institutional money that you would normally be leaning on to purchase, I'm assuming a lot of that institutional money also gets affected, during that downtime. Is that money still as accessible to be able to take advantage of that lower market? Is it more private money that you're developing the relationships with, or can you elaborate on that?
It's both. And that's why we're constantly borrowing money, because I want to build relationships while we're buying and selling at the top of the market. So when we want to buy at the bottom of the market, we have already established relationships. Approaching an institutional or private lender at the bottom of the market with no experience when the market's in disarray, that's going to be a tough ask. So yeah, definitely right now, trading people's money. You use their money, you buy it, you sell it, you pay it back. That transaction of borrowing and paying back both at the private and the institutional level will reap huge rewards when the market flips the other way. And there's different institutional players that come in, they recognize the opportunity. So there's going to be a lot of opportunity funds that enter the market when the time is right. But just so people don't freak out, it's not important to call the bottom of the market. Why? Our last trough was 4 years. But if you look at what happened at the top of the market last cycle, it is important to call the top. So one thing I would just caution everybody, the reason I'm more cautious at the top, because when things flip the other way, you're caught in a fly trap. You can't get out of it because you can't sell it because you owe more than what it's worth. You can't rent it and cash flow because people aren't paying, or rents start to come down the other way. You can't cover your payments. You end up in this cycle. You can't get rehab draws. This is where last cycle we saw half-built homes. Why? They didn't want to issue the next draw because the values had changed. They said, well, you got to bring cash to the table for the next draw. And this is where everything starts to degrade. So for me, being conservative at the top is good, because when the market flips the other way, it is important to call the top, but it's not important to call the bottom of the market. There will be plenty of opportunity next cycle when things flip the other way to be able to make calculated decisions and buy assets that from a buy and hold standpoint make a ton of sense.
Great stuff. Mike, you want to chime in? You can unmute yourself if you like.
Yeah, thanks, Don. Lee, thanks so much for taking the time. I love the first opening line that you made about agents getting in the way of transactions, because that is the biggest challenge in my industry as a realtor. So thank you for mentioning that and acknowledging that. I wanted to talk specifically to your comment about selling off all of your assets. I'm a real estate investor. I've flipped probably 50 houses or so. I own a whole bunch of rentals currently that we bought back when they were $19,000 to $30,000, and we have a really good cap rate. On your lines of business, do you run each line of business, regardless if it's rental or flipping, at a different cap rate, or just do you base it on ROI and balance sheets?
So for me, I look at, if you take an example of the properties you bought at that $30,000 price point, your IRR, if you cash out now, is probably 25 or 30%. I mean, it's just nuts. And so for me, if you're beating the market, you sell, because over a long period of time, the markets, if you take the stock market, for instance, what's funny about the stock market? I use this as an example. The stock market, on average, if you did nothing, would make you 8%. You know what the average investor makes? About 3%. Why? Because people buy high and sell low, because they think they can beat the market. And so for us as real estate investors, we have a unique opportunity. There's such swings in the market where if you've bought low, taking your chips off the table, you've got above average market returns. It makes a ton of sense. It's very hard to dissuade me from that position. And especially now with tax laws changing, you're going to see that, capital gains and things are starting to be taxed at a different rate. And I see a lot of change over the next couple of years. And so for me, taking chips off the table and having cash in the bank, having liquidity, being able to pivot, it's very difficult for me not to find a good argument not to do that. And especially for someone like you who bought low, you can take your chips off the table at peak pricing, or you can watch that degrade. And then, you say, well, woulda, coulda, shoulda, right? Does that mean you should sell everything? That's a business decision for you. That is a business decision right now. Believe it or not, Mo, we do actually find $30,000 deals, but that's because we beat the market because we're focused on a sales process. So if we were buying at market prices, we couldn't buy at $30,000, but because we focus on distressed sellers, we can beat the market. We buy parts of homes, like 1/3 of a home from one area, and we pick up the other third and we buy it in parts. So we do unique strategies where we can beat the market. But for someone like you, you've got to make a business decision. You've got to look at, okay, what's my basis? How long have I owned it? What can I cash out for? Minus friction costs. What's my IRR? And I think you'll find for someone like you that you're going to look at that and be like, holy crap, this is insane. I can take a huge return off the table, or even sell a portion of that, where essentially you've got a free roll on the rest of your real estate. But that's a business decision, Mo. That for you is a business decision. So for us, we bought at a 15 cap, but by the time we sold out, again, it turned out to be a 25-30% IRR because of the time period we owned it versus the cap rate that already existed. You add those two together, that rate of return was insane.
So I wanted to touch on something else that you said when you're letting go of all of your assets. Everything's for sale, which I agree. Everything has a price regardless of the time or the economy. Everything has a number on it. Just depends if you can find that number. So I've done quite a bit of research on this. I used to work for the large financial institutions prior to getting into real estate. I've held fairly, high level positions within JP Morgan Chase, Fifth Third Bank, HSBC. And I was always looking at the data, and I'm glad that there's someone else out there that's looking at the data. So I kind of wanted to give a counter perspective to what you were talking about before and get your thoughts on it. So in 2008, the economic downturn was caused by corporate greed, mortgage-backed securities, credit default swaps, and that's what caused the real estate market to get to depression levels that we haven't seen in 100 years. Well, now it's an intentional shutdown of the financial industry because of a pandemic, and we won't go in the political side of things, but I'm not sure that I'm seeing the big drop. And this is where I wanted to get your opinion, because there's so many comparable sales that are out there. There's roughly 3.5 million foreclosures that are sitting out there waiting to be processed, and you're 100% on the money because, with the mandates, there's judges and people that have quit and court workers. So it's going to take longer, 2, 3, 4 years to get through the court systems to get those people out of those homes and then eventually get those homes to market. However, as far as the downturn, I personally don't think that we're going to see, $200,000 homes going for $30,000 again, or $500,000 homes going to $300,000. I think we're going to see at most maybe an 8 to 10% dip, if that, and more likely than that, probably 5% in states like Florida, because we've been undervalued compared to, the Californias, the Texases, and the New Yorks for so many years. So I wanted to get your perspective on that.
Well, this is where, as an investor, we actually beat the market. So a lot of what's, I think, off-putting or misleading, should I say, on that topic, people last cycle pointed to national data. Every market's different. So, and even within each market, there's going to be different asset classes that have different levels of a drop. And then on top of that, you've got the retail market, which may drop 10%, but you've got the wholesale market, which is the market that I operate in, which you buy significantly below retail. So that will be my initial comment. I'm looking at what I, as an investor, will be able to buy, which is going to be different than the retail market. I would say that we're getting into crystal ball territory here, but what I would say is that in the FHA concentrated neighborhoods, there is a large default rate. Again, we got a quoted number, depending on who you ask, 14 to 17% default rate. I tend to believe that there's games going on with the banks on how they're quoting those numbers. The default rate's probably more like 25-30%. It actually far exceeds last cycle on those numbers, but I do think that the cause is different. I'll 100% agree with you on that. However, there's a huge disparity between FHA and conventional, which did not exist last cycle, which can't be ignored because that's what the data shows. So how that opportunity is going to manifest itself for investors, I think is going to be a question that we'll have to wait and see. But what I am confident is that there will be an opportunity based around that loan type. And that's where I see the data directing me. It's very clear that the opportunity of distress inventory is going to be centered around over leveraged FHA loans.
Well, I appreciate you giving your perspective on that. I'm kind of interested to see how Dodd-Frank is going to affect it, because the lending guidelines are substantially more strict compared to what they were 05, 06, 07, when, you were a janitor and you just give stated income of $100,000, where now it's over verified. There's lots of disclosures, and, not to mention, it seems like there's a government backstop for everything at this point. So are they going to go ahead and bail out some of the distressed, individuals that may have been out of work due to whatever circumstance, which it seems like that's almost like the norm now, which then could also affect in a positive manner the real estate market to make it stabilize?
Yeah, I would say that underpricing has definitely been, that we closed the gap this last 12 months. And this is where you saw the Tampa Bay market, both the rental prices and in the median price jump. That gap was closed pretty quick. If you think about 25% in 1 year, you're talking going from, mid to high 200s to now 350. I mean, it's shocking for me to sit here and talk to you guys where the average home in Tampa Bay is $350,000. The reason I say that, if you look back at the data from 2009, anybody want to guess what the median price was back then? A quiz. Now bet 85,000.
Wow.
Yeah. So people forget really quickly where the market was. And I say that to you because if you look back at 2005, 2006, it was hitting about 300,000. It went down to about 85,000, and now it's back at 350,000. Now, the reason I say that, Tampa Bay and Vegas would be two examples of what we call bellwether markets that really demonstrate the highs and the lows in the market. Vegas went through a similar cycle. You could have bought as many homes as you want. By the way, every home, and I say this as a general statement, almost every home in Vegas was built approximately in the 90s. They're all the same, 1,500 square foot, 322s. Those houses were going en masse for about $70,000 or $80,000 for about 2 years. And so, I had personal friends that would show up with $5 to $10 million in cash at these auctions, buy it till they ran out of cash, go back and get more cash and go back to the auction the next day and buy homes. People forget we're now 4x what the median price was just 12 years ago. And even in the last, you take 5 years, there's been a huge run up in the market, huge run up since 2016. So I still believe what I'm saying, Mike, that for the market just to settle down to an average, on a normal moving average, we're overinflated today. And I would argue more than 5 or 10%. But again, we're comparing opinions here, and you're entitled to your opinion, I'm entitled to mine, and I just want to present my opinion on this panel, and that's what my job is today. That's why Don brought me on here.
Appreciate it, Lee, and appreciate your contribution, Mike. Great questions. Two last things as we wrap up here.
Sure.
Obviously, our main topic is building wealth through real estate investing. I'm curious as to what your definition, Lee, of wealth is. And,
sure.
And I say that for this reason. I've known many investors who really focus a lot of their energy on passive income, right? And they define wealth as being able to create enough passive income to pay for their expenses and having a kind of a freer lifestyle is how they would define wealth. Other people would look at wealth as building that nest egg and hitting a certain amount in the nest egg, or having a certain amount of equity and property, and how that, even though it's not liquid, they know that they can sell that when they want to. And so I'm curious on your definition of wealth, and if you mix and match those strategies from a standpoint of, do you have a certain percentage of your portfolio that's very passive income oriented, whether that's like on notes, and obviously rentals can fall into that category, and very hands off in terms of where that cash flow comes from, compared to some of what you described earlier, which was that, you were spending a lot of hours. In fact, it even hurt your health. I remember seeing some of the challenges you had health-wise years ago. just because the opportunities were so massive and you were working like a maniac to take advantage of it, right?
Yep.
And so how would you define, your concept of wealth and what you've learned over the years on that?
Freedom to do what you want when you want. And so for me, I'm at the end of my career. I've got 2 or 3 years left between the cannabis opportunities that we're pursuing, which will have either an exit to a large player or a public sale, which will go public. And between the next cycle of acquiring passive assets, which will be just at that point, just a buy and hold opportunity. For me, it's stepping out of the market. I will say this though, Don, a lot of people get into the rental game with a passive investment that becomes an active business. And what I mean by that is that they're taking tenant calls, they're collecting rent, and they've got this beautiful, what they call passive investment, but you actually get behind the curtains and they're spending 20 hours a week managing the rentals, 30 hours a week. And so just don't fall in the trap of defining an active business as being active income. So for me, I spend at this point 90% of my time building the cannabis business, which is at this point, we're building $1 billion business in the cannabis space, and I spend 10% of my time in real estate. And so even though the majority of our income is from active income, it's not an active business for me. And I've seen the complete opposite with investors. Another thing I will tell you guys, you're not going to make money off 10 rentals. I did not start to hit my stride until I had 100 rentals, because then I could hire people to make sure it was an actual passive business, which means I never talked to a tenant. I didn't have anything to do with the business. You can't hire people until you hit a certain scale. So for those who are trying to build wealth in real estate, understand just because you're buying a rental does not mean it's going to be passive for you. You may be on the hamster wheel of dealing with tenants and evictions and trash outs and renewals and rentals and all sorts of hassles and lawsuits and all sorts of nonsense that comes along with tenants. For me, that's a difficult business. It's not passive. Tenants, toilets don't fix themselves. I know we joke about that. Troubles, tenants don't sort themselves out. These are all problems that need to be dealt with. So my big encouragement to you guys, if you're going to pursue a rental portfolio, have a scaled plan for that, which means you can hit that threshold where you can hire people. And I will say this as we kind of, crawl before we walk. I was able to start hiring people where it didn't cost me money. I think it was about 20 or 30 units. That's when I could actually hire someone to run that full time. And at 300 units, I believe I had depending on the points over the years, it was 2 or 3 people managed that portfolio to make sure it was completely passive, where I never talked to anybody. There was enough rent to actually justify that. The problem right now, you're buying today, the delta between what your total cost is and what your actual free cash flow is, it's going to be very tight. And so that's another thing that people ignore. I've seen a lot of, gurus, and I guess I'm one of those. I've been in the real estate education space for 12 years, promoting, buying multifamily at $100 a door. You can't effectively make money if you're pro-forming making $100 a door. You want hundreds of dollars a door. And so that's another issue right now. You're buying at peak pricing. Yes, you may get a good interest rate, but that actual free cash flow does not allow you to hire out the business, which means you're running on really tight cash flow. Let's take an example. You have $100 cash flow, the air conditioning units for 5,000 breaks. You know that you're not making money for 4 years on that property. People forget this. They don't think about this stuff. They really don't think about it. $100 a month means a $5,000 repair means you are not cash flowing. Again, that's assuming the tenant pays every month on time. There's no turns, and it's 100% payment history. You literally will take 5 years to make a penny on that property. Now, will you get tax write-offs? Yes, but I'm talking about cash flow. So just, again, Mike, you've been in the business for a while. You bought right, so I know you're cash flowing in your portfolio. But a lot of people buying today are going to learn that cruel lesson that one major repair and you now have to shell out money. And this passive investment, A, turns into a bunch of hassle, and B, doesn't actually cash flow. So, I think that concept of wealth, we got to really make sure we consider equity and cash flow and time investment. That's really what I'm encouraging everybody to consider.
You're right. It doesn't make any sense to buy a rental property just to beat your chest and say, look at me, I have rental properties. And so we were able to buy all of ours for cash at auctions, and it was on average 19 to 35,000.
Yeah.
And now they're all worth 200, 250.
Yep.
And the ROI monthly is fairly substantial to where we can leverage those funds and then put them into further investments. But I'm glad that you brought that up, because there's a lot of outside investors coming in here that are using other people's money to make money, which is fantastic. But if you're only making nickels and dimes, it makes no sense.
Well, I think that, again, we're running out of time here. I would just encourage everybody, don't fall in love with owning doors. Fall in love with equity and cash flow and having free time. That's the things you should fall in love with. And if you can get all three, great. But if you don't, just walk away. It's not worth it. So just owning a door, you end up thinking you're owning an asset. What you actually own is a liability. So something to keep in mind.
Great stuff, Lee. The last thing here is just that for people that want to continue educating themselves and on all the different strategies and vehicles for real estate investing, where can they learn more about you? I know you're in the educational space, as well as some of your favorite like podcasts or books or real estate investment communities that you participated in. What do you recommend people get themselves involved with, or how they educate themselves?
Sure. If you want to connect with me on Instagram, it's real Lee Kearney. That's easy to find. Probably Google me. It's easy to find my cell phone number, I'm sure, at this point. I actually only do one thing in the real estate education space. I've got a high level mastermind. It's a couple dozen people. It's a small group. That's the only thing I do now. At this point, with most of my time going into building this MSO cannabis business, I spend the majority of my time, because that's really the vehicle that's going to get us to building $1 billion business. Right now, with real estate at peak pricing, we spend a lot of time on that. But I do teach a small mastermind group. That's the only thing I do. So if you're an active operator, that might make sense for you. But as far as other areas of real estate education, I don't do it. As far as people I follow, maybe it's a random list. I like people like Jordan Belfort, for instance. Why? I like people that hit the top, lost it all. I like people with life experience versus people that are just always happy. Everything's perfect. Everything's going well. And I like to learn from people that really screwed up, because I think they've got a really, really balanced approach. I can relate to that after doing really well and losing everything. I like to learn life lessons from people that go well beyond business. And so that would be an example of someone that I would follow, listen to their podcasts. And I enjoy just understanding, that rags to rags back to riches story. That to me is I think creates a more well-rounded individual. You can get obsessed with just making money. And again, if money was the only thing that made you happy, why are people in Hollywood killing themselves, right? Clearly money isn't the only formula. There's got to be balance in your life. And, I like Tools of the Titans would be a good inspirational book I've read. If you really want to organize your business, Traction would be a book that I read that really helps you understand that EOS process and create a more traditional way of running a business that is grounded for decades in just solid business principles.
Yeah, I love Jordan's book, Straight Line Selling. It's a great book. I've gotten a lot out of that from a selling process standpoint.
Yep.
And Traction, every book you just mentioned is also a read. I know Mary just held up Traction. I love that book as well. Bigger Pockets is a real estate investment community that I think has pretty good content as far as investing. So as for those of you who are interested in learning more. But I want to thank you, Lee, for your time and immense amount of value that you brought today. It means a lot. And this is recorded and live streamed on Facebook, so anybody can rewatch it if you want to. And wish you all the best and take advantage of that next market cycle, Lee. Looking forward to it.
Thank you. Thank you, everybody.
Bye, guys.